Good morning and welcome. We'll just give a few people some time to log on. It's exactly 11 o'clock now and let's begin at 11:01, but welcome. As we're waiting for a few moments for more people to gather, I'd like to welcome Kingdom and Mervyn and Dina and his team at Netronics and Nolu from Alan Gray, my son Prashant, Sipo and Gobo, Wim from Pata and Pata, Yvonne from Fire Check, and Nalisha Pillay. Welcome Wayne Govender from High Tech Graphics. Good morning, Percy Govender and Mark Graham. Thank you for coming. It is 11:03 and I'd like to get started with the presentation. We are recording it, so if anybody is late, we can send them the recording. But the most important thing is to thank you for attending. We understand the pressures that exist on your time and appreciate your attendance, so thank you for that. The reason for this particular webinar is that a few clients have been telling us that the problem they have is that very often their highly trained, experienced and qualified employees go away to work for multinationals around the country, and while they have embedded these employees at a high cost with knowledge, skills and best practices and training, they lose them to corporates. And is there a way in which we can try to solve that by getting their best employees or their key employees to have a longer term commitment or incentivize them over the long term? So the old approach of dangling a carrot incentivizes employees by rewarding their contribution to the company's revenue. And we find more and more that when incentives are meaningful, then your return on investments are kept. And this morning, this is what it's about. It's about trying to reward our key employees and not only reward them, but find a way in which we can incentivize to continue to do work for the company and not to run away at every moment they choose. So that's an important part, that the incentives are there. So to kickstart right now, I'd like to introduce you to Kajal Maharaj, my PA for more than 26 years. And she's going to be preceded by Avanti Ramata, my daughter. So it's over to Kajal right now. Thank you.
Good morning, everyone. And thank you for the opportunity of meeting all of you all this morning.
Good morning.
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 Morning, Mark. So let me start by saying one of the most valuable assets of a business is its employees, especially those with relevant knowledge, skills, and experience. The preferred compensation was created to benefit employees during his employment with a particular employer, with the aim that he will remain with the company for at least a few years. It is a valuable tool and used to motivate and retain key employees. A high staff turnover is the most costly business risk, as it results in loss of productivity, intellectual property, employment costs, and training costs. It's estimated that losing an employee can cost a company 1.5 times to 2 times the employee's salary. Therefore, it is important for a business to retain and incentivize its employees in ways the employees themselves deem fit and valuable. I'd like to pause for a moment here and ask you all whether there are any methods of retaining your employees that you would like to mention. Our clients participate in a vast range of industries, So there may be very different methods used. I'll give you a few examples. Some of the methods commonly used are salary increases, corner offices, bonuses, new company vehicles, and promotions. Please feel free to add to this list. So what are the problems with these? They have to be funded from cash flow, but more importantly, they don't have the potential of keeping the employees loyal for a long term. Once these incentives are received, there is no binding effect that incentivizes these employees to remain with the company. Salaries and bonuses do not leave the employee in a cash neutral position, as they may move to a higher tax bracket. Listed companies embed their employees by offering them unvested shares. These unvested shares only vest at the end of each 5-year period, thus making the employee loyal for this period. However, this becomes a messy proposition for private companies. It is common practice that most successful companies have employees' benefits in place, and these are pension, provident, retirement benefits, which include disability cover, dreaded disease, and funeral benefits in some instances. While these benefits are valuable, they do not have the capacity to keep the employees from finding new employment with your competitors, as these benefits are portable. We suggest that employees are incentivized by preferred compensations. It is a worthwhile alternative to be explored. I'd like to hand over to Avanti, who will give you some examples and illustrate how preferred compensations work. Okay.
Morning. In our first example, assuming an employee earns 50,000 Rand per month, we would like to incentivize him by rewarding him with a 500,000 Rand payout at the end of 5 years. The company funds the premium of 7,500 per month, which is paid to the employee as part of his salary. But in order for the employee to remain in a cash neutral situation, the salary increase must also include the increase in the tax payable on behalf of the employee. Here is another example in which an employee earns 100,000 Rand per month, and the employer would like to incentivize him by rewarding him with a payout of 1 million Rand at the end of 5 years. The company funds the premium of 15,000 Rand per month, and here again, the actual salary increase must also account for the increase in income tax on the employee's behalf. Moving on to highlight some of the benefits to the employee, the proceeds at the end of the 5-year term is a tax-free benefit in the hands of the employee. Additionally, it is beneficial for the employee to have the employer cover the marginal tax incurred by the salary increase. We recommend a service agreement that safeguards both employer and employee. The policy is owned by the employee and ceded to the employer as security for his undertaking. The employer is bound to cancel the security session at the end of the 5-year term. The service agreement leaves no room for misuse of the preferred compensation agreement. It is a form of forced saving for the employee. It does not affect any retirement funds or compensation schemes, But unfortunately for the employee, if he decided to leave within the 5-year period or is found to be dishonest, the policy pays to the company. Here are some of the benefits to the employer. It is a unique way to retain employees, securing their services for at least 5 years. The total amount paid by the employer is tax deductible, as it is part of the remuneration of the employee. In other words, company profits that would have found a way to SARS are redirected into a preferred compensation, which helps retain your key employees. This is an important benefit. The employer is also protected by the service agreement because of the security session. We'd like to move on now to any questions you may have. You're welcome to ask questions on the calculations or the benefits, and all three of us will be happy to answer for you.
I'm going to take the opportunity of unmuting all of you, and please, you're welcome to ask any questions or make any comments, please.
Hi there.
Hi. Hi, Shan.
Hi, how's it doing? Shanja.
Yes.
I just want to check, so that payout at the end of the 5-year is
Yes.
tax-free in the hands of the employee?
Shane, sorry, I didn't hear that. Is tax-free?
I said, I'm just,
Yes.
yeah, is that payout at the end of the 5 years
Yes.
tax-free in the hands of the employee because effectively he's paid the tax during the 5-year period on the additional income or on that saving portion?
That's correct. The
Okay.
example that Avanti gave, and could we just go back to the example, Shan? It may help us all. So there's the part here right now. In this example, while 7,500 rands goes into the policy, what we're paying the employee is 11,700.
11,000, which includes the tax.
Which includes,
okay. So then that payout at the end is tax-free because he's paid the tax during the course of the.
Yes.
Now, I think the other thing which I'm sure many people would want to understand is if you do this and you're locked into a 5-year,
Yes.
and during that 5-year period something happens, the employee either leaves or gets dismissed or whatever, right? Then what happens to that? Firstly, can that policy stop? Secondly, what are the surrender values or sort of what kind of recovery can the company get out of that?
Yes.
And then are there any tax implications for the employee? Not that it's our concern, but I'm just interested to know.
Yes. So thank you for all of that. I'll start with the last question, Shan. There are no tax implications for the employee. There are some things for the employer. And you know that the 4-fund approach applies to these endowments, which are in place for 5 years. We're not using a life company endowment. We're using a unit trust endowment. So to answer your first question, there's no penalties involved. So the accumulation of what's in that endowment pays back to the company. Depending on when it starts, there may be a small tax implication that we can only say as and when, but it's not going to be more than that the company put in. So,
Okay.
Does that explain it, Shan?
Yes, sure. I covered it.
Thank you. There's also no CGT and no estate duty. So the proceeds, either the 500,000 or the 1 million, is really a bonus to the employee.
Yeah.
And he gets it, and he can do whatever he likes with it.
Right.
So some of you that are here this morning, thank you for that. My old client and colleague, Jay Owa, we implemented one of these in 2007 or 2008 for one of his most trusted employees, and he got a very handsome payout of in excess of 1.1 million a few years later. Jay, you might want to say how that worked for you. Oh, Jay may have left. Yeah.
Sorry, Hiren, can I ask you a question, Hiren?
Certainly, yes. Percy?
Yeah, sorry, but I'm driving, but I'm got a hands-free. My
Yes.
question is, what happens if the employee dies before the 5 year? Who owns that policy? What happens to the payout? And what is the tax implication thereof?
Percy, thank you for the question. I don't know the answer. I would assume that because the employee would still have been in employment, that the accumulated part could pay over. But Percy, I don't have the full answer on that right now, but I could come back to all of you with that.
Oh, thanks, Hiren. Thank you.
Okay, sorry. My daughter has the answer. It goes to his family, Percy.
Okay. Okay, and the tax implication thereof?
Look, at the end of 5 years, it will still be tax-free. On these endowments, because of the incentives, there is a small amount to pay over the years, and that we know as and when as a point, but largely tax-free.
Okay. Now I'm thinking about before the 5 year plan.
Before the
That's
5
what I'm
years,
talking about.
there would be
Yeah, the guy dies on the year 3 or something, or year 4.
right.
What happens?
Percy, I'm not clear on the tax,
Okay.
tax, but I would assume that there would be a very small portion, because how the tax-free thing works is that the accumulated part for the previous year becomes tax-free.
Okay.
Because 30% gets paid. The
Okay.
of the 15% may be there, but I assume it would be even smaller than 15%.
Okay, no problem. Thanks, Hiren. Thank you.
Thank you, Percy.
I think just to clarify or just to ask Hiren,
Yes.
the issue is if the guy dies in year 3, and I think the tax thing, I'm sure, there's a way around it, or it's not taxable because effectively you're paying the tax each month
Yes.
via the company's contribution. The question is, if in the say year 3 he dies, does that go to his estate or does that revert to the company? I think that's the important question.
Yeah.
The tax implications, if the guy's getting something, he's going to have to pay the tax. You can't escape that. But who owns the policy in that interim period?
In that interim period, Shan, the straight answer is that the company owns the policy because, as we said at the outset, the company is instituted in the name of the employee, but because he isn't paying for the next 5 years, there's a cession to the company. So it becomes company-owned all the period. What I'm not clear, and I would find out, is how those benefits get paid to his estate or his dependents. And much like Percy asked earlier, what the tax benefits would be within the 5-year period. I'm clear on at the end of 5 year. I'm sorry, I'm not clear within the period.
Okay.
Thank you. Jay, were you about to say something? Can you unmute him?
Can you hear me now?
Yes, we can.
Okay. My question is, if we do a policy for a key member,
Yes.
and then we find after year 1 or year 2, it's that person wants to leave. Okay, that's one question. The second question is, if you take a similar scenario and then the company decides that, listen, due to some default from the person, the whole lot, and we want to cancel the contract and some sort of thing like that. What happens in those instances?
Yeah, the law is quite strict on that, Siva. Thank you for the question. The service agreement makes mention of this, and that is that the only time the policy proceeds revert back to the company, so to speak, is if unfortunately the person was dishonest or if the person resigned. And and I know that there may be a loss of favor with an employee, but he was not necessarily dishonest and he doesn't want to resign. that leaves us in a bit of a sticky position. Sabah.
So many different.
Yeah,
Yeah.
we can't just willy-nilly say now that we've lost favor and we don't want to continue it. The methods of stopping the continuity or reverting the whole proceed back to the company is only for dishonesty or for resignation in the 5-year period.
Okay, thank you.
Hiren, sorry, I just want to ask something. It's Candace.
Yes,
So
Candace.
if you were to terminate an employee during that time for poor work performance or any other reason other than dishonesty, you know, there's a few other grounds, it's within that 5-year period. So would they still be entitled to it? My understanding is that we obviously hold the session to that policy for the 5 years.
Candace, thank you. Avanti wants to answer that question.
Hi, Candace.
Hi.
So every service agreement is actually different. So at the outset, when we're drawing up the service level agreement that goes with this preferred compensation, you can put in clauses that, you know, if the performance level is not at a certain level, or if there's other levels of dishonesty or non-performance, it could be built into your contract.
And then one last question: the figure that we came to, or the monthly figure that's on R1 million at the end of the 5-year term.
Yes.
Am I right? So are we able to do does it have to be that year, or
No,
it doesn't have to be?
it doesn't have to be that year. So the amounts as well don't have to be these particular amounts. We just use this as an example.
The minimum at all, or
Sorry?
the minimum amount that we can do?
Yes. Yes, there's a minimum of R1,000 per month.
R1,000, okay. Yeah, because obviously if we want to stagger it between key employees versus ones that are a bit lower, but it's a benefit we want to maybe do across the board or not. It would.
Off top of money, let's say.
Yes.
Okay.
Okay, I have a question. Will there be an escalation every year?
No, Sabah, in this particular one, the way we exampled it and drew it up, because every year there's a tax implication, we try to make it easier for people like Shan to do this. So we left it flat for the 5-year period. So it's done once in the beginning, and depending on how the person's salary increases, there may be small implications, but we don't have an annual increase on the policy.
Okay, thank you. And once again, the contribution between the employer and the employee, what percentages contribution?
So we used an example that if an employee was earning 50,000, we'd like to benefit him by giving him a handshake, well, not a handshake, but a bonus of 500,000 after 5 years, Sabah. So we just made that easy. But if you're paying somebody R1 million or 100,000, then we're wanting his bonus to be R1 million. And at the outset, what we're trying to do with this is we're trying to make the 500,000 meaningful for somebody who earns 50,000, and the R1 million meaningful for somebody who earns 100,000 a month. And we didn't want to make the years longer than 5 years, because sometimes the 5-year time horizon, we can see ourselves getting that pot of gold, so to speak. When we speak about 10 years, and the whole purpose in this is to try and keep your key employees with you. But when you think about a time horizon of 10 years, it's a bit long. So the premiums are high here because we, in a short space, want to benefit him with either 500,000 or R1 million. But much like Candace asked earlier, the figures could be as low as R1,000, and then the benefit would be smaller proportionately as well.
Yeah, Hiren, sorry, because I thought maybe something that would be nice is to base it on their salary. So you could say yours would be 2 times your annual salary at the end of it. It's like you always bank it, for the next 5 years.
Yes.
Even something as, it sounds little, but it's as if they've had two years worth of salaries saved away.
And certainly that can be done, Candace.
It's still a tangible figure.
Correct.
And something that they know is there.
That's right. No, thank you for that.
Is there any possibility of doing two plans? If we gave you a few scenarios of 4 or 5 people, I'm just asking, and then you have a 5-year plan and a 10-year plan. Is that possible?
Yes, the answer is yes. We
Okay.
certainly can do that. Yes.
All right.
So just one thing you mentioned about the employer contribution and the employee contribution. My understanding from listening to this is that there is no employee contribution. It's purely an employer contribution. The employer contributes 100%, including the tax.
Yeah.
So
yeah.
it will not affect the employee's take home on his normal salary.
Okay.
So effectively, the company funds the entire policy, including the tax, which then allows the company to claim the tax deduction and allows the employee to receive a tax-free benefit at the end.
That's correct, Shan.
Okay. That tax rate is 41%.
Yeah. That's
Yeah,
right.
well, you have to pay the tax at the marginal rate, yeah.
Yes.
Mm.
And Shan, because that becomes a benefit and it's not seen to be a salary sacrifice.
Yeah, correct, yeah.
Okay. All right. I think
Hiren, can I ask another question, Hiren?
Certainly, Percy, yes.
The deferred compensation scheme, does it work for sole proprietor as an employer or only for juristic entities?
I'm aware that it works for CCs and PTY, which are juristic. I haven't used an application for a sole proprietor, but it's something else that we can investigate. We're making a list of the questions, so we can come back to you on that, Percy.
I don't think
thank
it'll
you.
make a difference because I think the fundamental of this would be a contract of employment. So if you have a contract of employment,
Right.
And you can link that policy back to that service agreement or that employment agreement, it doesn't actually matter whether you're a CC or but you would have, that person would have to be, all the normal registrations would have to take place, SARS and PAYE and all of that, whether it's a juristic person or a sole prop. I don't think it'll make a difference. Certainly from a tax point of view, it won't. And I don't know from a legal point of view with the insurance company, whether they may have other stipulations about who they transact with. I'm not sure.
The question I'm concerned about, if you're working for a sole proprietor, and the way I understand it, when the sole proprietor dies, then you have to claim against his estate because it's not a juristic. There's no perpetual succession plan for the sole proprietor.
Mm-hmm.
And that may be a legal question to ask. That's what I'm concerned.
Yeah, that's a good point. Good point.
Yeah. On both the
So I think, the concern. Yeah, sorry. The concern I have, because if the employer dies and he's a sole proprietor, you got to claim against his estate. So the employee is going to claim against it. In a juristic entity, you got to claim against a juristic entity, which can automatically or otherwise you can get some more benefit out of that. I don't know the legal concepts. I'm more accountant than a lawyer. That I think we can get some jurisprudence on that matter.
Yeah, definitely.
And about 99% of our clients are either a CC or a PTY. But Percy, we come back to you on the sole prop.
Oh, thanks, Hiren.
Thank you.
All right. Any other questions, guys?
Yes.
I think that's about it from our side, Hiren. Unless
Thank
anybody else has a question.
Yeah, that's it.
Jay, did you want to say something? And Rodney, do you want to say something?
Hiren, they've answered my questions. So,
thank you.
Yeah, that's what Siva was talking about, what I wanted to know.
Yes. I was
Okay, my friend.
I was just asking you because you have had an experience of giving somebody quite a large sum of money, and as an employer, how did that make you feel?
Oh, it was great. I made the guy feel better, not me, but it was like, it was a good thing to do.
Okay.
I think most businessmen should be doing that, not just making money only. Should be looking after the employer. important.
No, thank you for that, Jay.
And you can be rest assured you're going to get your productivity and your honesty is going to be so much good, so much better.
Yes.
Okay, my friend.
Thank you. Thank you, gentlemen and ladies.
Right.
Thanks very much.
Thank
Thank
you.
you.
Thank you.
I had
Thank you. Bye bye.
Thanks, Ed.
Cheers.
Cheers.